Does higher yield always mean more risk? With more than 30 stocks and funds, are you over-diversified? And why don't you invest in high-yield tobacco stocks like Altria? These are some of the questions I'll answer in today's Q&A. Does higher yield mean more risk? Well, my portfolio currently yields more than 10%, so if high yield means high risk, I'm in trouble. Generally, higher yield is an indicator of risk within an asset class, but not necessarily across asset classes. Ares Capital offers a higher yield than, say, Walgreens, but I consider ARCC to be a lower risk investment than WBA. They're completely different types of investments. If you bought the highest yielding stocks in the S&P 500, that would be risky. Walgreens yields about 8% and Home Depot only yields about 2.2% because Walgreens comes with more risk than Home Depot. I'm a high yield income investor, but a high yield stock like Walgreens is too risky for me. When regular companies like this pay a high yield, it's usually a sign of distress. The average yield of the S&P 500 is very low because these corporations are optimized for share price growth, not as much for dividends. To minimize risk, I have to look elsewhere to asset classes that are optimized for income instead of appreciation. For example, the company I just mentioned, Ares Capital, is a business development company that lends to medium-sized businesses. It's hardly ever on CNBC, it's not famous. The ticker is ARCC and it currently yields 8.35%. If ARCC yields more than WBA, does that make it riskier? No. And if you avoided ARCC for the past 20 years because an 8% yield must be too risky, you would have missed out on this. ARCC's high yield wasn't the signal that it's a risky stock because ARCC is a business development company and BDCs are designed to pay high yields. The average yield for a BDC is 11.4% according to this Raymond James report. That makes ARCC's 8.35% look conservative. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. The reality is that some BDCs are riskier than others, but they all pay high yields because BDCs are structured much like a REIT. Both are taxed as regulated investment companies or RICs. In order to minimize their corporate tax, BDCs and REITs are required to pay out at least 90% of their taxable income to shareholders. So in this asset class, the yield isn't high because of risk, it's high because most of the returns are in the form of income, not capital appreciation. There is one risk that's common to individual stocks and BDCs, concentration risk. CEOs can make mistakes and occasionally well-respected companies fail. So risk can be further reduced by diversifying into a fund like PBDC that actively manages 21 BDCs. It's not as old as ARCC, but since its September 2022 inception, it's kept up with the S&P 500 for total return and currently yields over 9%. By the way, the 13.94% expense ratio shown on the website is a very confusing number, but don't worry. The SEC requires BDC funds to classify operating expenses from the companies that it holds as fund fees. It doesn't really make any sense. The actual management fee is 0.75%, which is clearly stated in the prospectus, which is fairly normal for an actively managed fund like this. Also, the quoted yield is the amount you receive after that 0.75% management fee has been deducted. Another example of high yield not necessarily equating to high risk is preferred shares. These are shares that pay out a defined income stream. They have limited upside if they're callable because in that scenario, the company can buy them back from the investors for $25. That means they won't trade much above $25. So to compensate for that limited upside, the yield is pretty generous. You can buy a fund like PFFA that owns a diversified basket of preferred shares and yields just over 9%. If you want to learn more about PFFA, and preferred stocks in general. This recent interview with the PFFA fund manager covers it in detail. The last high-yield example I'll mention today is covered call index funds. Let's say you pick one based on the S&P 500, like SPYI. It's currently yielding almost 12%, not because it holds risky assets. You might argue that the S&P 500 is overpriced, but they are quality companies. The risk of 1% of them going bankrupt is very, very small. The risk of all of them going bankrupt is 0. SPYI pays such a high yield because it sells covered call options. Effectively, that means it receives income every month from the buyers of those options in exchange for giving up some of the upside of the S&P 500. It passes on that income to shareholders monthly. So all other things being equal, higher yield signals higher risk. But as you explore various asset classes, things are not equal. For assets designed to pay 8%, the risk is much lower than for assets that are designed for appreciation. Next question, why don't you hold any tobacco stocks? The yield is good and there's a long history of dividend growth. These are two things I look for, so why don't I hold MO or BTI? This ties back to the last question. Tobacco companies are common stocks and they're not really designed to pay such high yields. If we go back to 2017, we can see that Altria, ticker MO, was only paying about 3%. The yield is more than double that now because the market is concerned about the long-term outlook for the tobacco industry. And so am I. This yield history chart came from Snowball, but I mostly use Snowball to combine my stocks from 3 brokerages into one simple dashboard. Sometimes I'm looking to sell low-yielding funds to buy higher yields, so I'll rank by yield to see how I want to rebalance my portfolio. And the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a discount and a free trial. Looking back in time, tobacco has been one of the best businesses in modern history, at least in financial terms. They sell an addictive drug, but it's legal. The cost of production is low, and when your customers are addicted, they're willing to absorb price increases, which increases profit margins. So companies like Altria had these fantastic distribution history charts that go back decades. This chart is a thing of beauty for an income investor like me. The reason I don't hold these stocks is that the good part is in the rearview mirror. And when I look through the windshield to see what's ahead, it's cloudy, or perhaps a better word would be smoky. As the health effects of smoking became clearer, tobacco use in developed countries has shrunk, and that decline is a one-way street. To keep that beautiful distribution chart sloping upwards and to the right, tobacco companies have simply been raising prices, but that only works for so long. At some point, the product just becomes unaffordable. Eventually, they have to create a replacement product that's as popular as cigarettes and with similarly huge profit margins. And that's an enormous challenge. Altria spent $12.8 billion on Juul in 2018 in an attempt to replace cigarettes with e-cigarettes. It failed, and Altria lost almost the entire $12.8 billion on that deal. Apart from trying to find a replacement product, which is difficult, the second hurdle is navigating government regulations for a product that's likely to harm the health of its users. As an investor, I would need to understand how the company will overcome these challenges and why the market is wrong to give these companies such a low valuation. Instead, I prefer to focus on income investments that are designed to pay higher yields and don't require a turnaround to succeed. Should you blend income and growth? This question asks about blending income investing with growth investing. I'm not a financial advisor, so I won't tell anybody what they should buy or sell, but I do want to acknowledge that income investing can be a single strategy, or it can just be part of a broader strategy. In this example, 3 buckets. Bucket 1 is $50,000 in cash, which I assume earns 4% at the moment in a money market fund. It's more than enough to cover current expenses, so it's also somewhat of a safety buffer. Bucket 2 is income. This is more my strike zone. Covered call funds, BDCs, and other asset classes like that are similar to what I do, and that 8 to 9% yield is in the lower end of the range that I target. Bucket 3 is growth. This is an easy bucket to manage because you can just pick a good index and it rebalances itself every year for you. It's basically set and forget. In this case, QQQ is a good example because it's based on the Nasdaq 100, which has easily outperformed the S&P 500 over the last 10 years. I think this works really well for a lot of investors. Each approach has its pros and cons. For example, income gives you cash immediately that you can spend even if the market is down, and growth gives you a higher return over the long term and it's more tax efficient. Some income investors experience fear of missing out during a bull market. There's a lot of that happening at the moment. During those times, an income portfolio will underperform the S&P 500. Blending the two strategies lets you experience the security of regular income and the excitement of seeing your portfolio grow in value. Most years, at least. This is particularly true if you retire at a young age. The growth strategy works best over a long period because that gives your portfolio time to recover from the bear markets. Then, as you get older, income becomes more important than dying with the biggest portfolio. Next question is about the minimum yield I'd consider. I'm targeting 8 to 12%, as I said earlier, so most investments will fall in that range, but not all. I'll look at investments yielding less than 8% if I get something extra in return. I'll give you two scenarios. The first extra is dividend growth. A good example is Main Street Capital. It often yields less than 8%. As I record this, it's yielding 5% or 7%, depending on whether you include the special dividends in the calculation. That's why Snowball and Seeking Alpha show two different yields for this one. Neither are wrong, they're just using different formulas to measure yield. Maine has a long and consistent history of growing its dividends, so even if you buy it just under 8%, historically, it would eventually pay you more than 8% against your cost basis. The second benefit that would make a yield of less than 8% interesting is low volatility. The viewer gave a great example, JAAA. This is a CLO fund that currently yields 6.3%. Not as much income as I'd like, but look at what the price does when the market is bumping around all over the place. It's steady like a rock. Some people like that because it reduces their stress. I like it because it gives you opportunities over the short term. Over the long term, the S&P 500 will give you a higher return than JAAA, but over the short term, if you're worried about the market being overvalued and you want to buy a dip, a low volatility fund like this pays you a bit more than 6% to wait for that opportunity. And that's easier to see on a 1-month total return chart. The S&P 500 was all over the place this past month, and selling some JAAA to buy the dips would have been easy. I currently hold some JBBB, which is its more volatile, higher yielding sister fund. But I'd consider JAAA if I was looking for something steady over the short term. If you'd like to learn more about JAAA, this analysis by John Bowman on Seeking Alpha gives an excellent overview. Seeking Alpha is the only place I've found decent research on income funds. I use it every day. I'll put a link in the description to John's article and a link for Seeking Alpha membership and a free trial. I use the premium level. Last question for today is about diversification. Why do you hold a maximum of 5% in any one investment? Is that over-diversification? This will be different for everybody, but a 5% cap works for me because if there's a major issue with one investment, let's say a dividend is cut in half, that would be major, the impact on my portfolio is small enough not to cause any real stress. On the flip side, a 5% cap means managing a portfolio of at least 20 investments. And I have more than 30. That's way too much work for most people. I enjoy researching and managing income investments, so it doesn't feel like work for me. For those that don't enjoy it, then I can understand how this wouldn't make sense for everybody. What about performance? I'm not trying to beat the market, so picking a handful of winners is irrelevant. My first priority is consistent income yielding 8 to 12%. My second priority is maximizing total return. And mostly that just means don't buy something with a high yield but a steadily declining price. Consistency is enhanced by diversifying into different asset classes that are exposed to different risks. The only limit on diversification is my time. I can't keep track of, say, 100 investments, but I can keep track of 30 or 40. For other investors, it might be 15 or 20. So that's 5 questions. We'll be back to fund reviews and interviews in the coming weeks. But if you like this Q&A format, click here for other Q&A episodes. More Armchair Income coming soon.
Armchair Income, that's my hustle and my